Let me ask you something before we even get started. You just got $60,000. Maybe it's a work bonus. Maybe you sold a car. Maybe your grandfather left you something. It doesn't matter how, you just have it. And you have to decide what to do with it. Most people I talk to already have their answer. They've had it for years. And most of those people have never actually run the full math on why they believe what they believe. In this video, I'm going to walk you through two brothers, same family, same city, same $60,000, who made completely different choices. I'm going to run every number honestly. I'm going to show you the stuff that doesn't make it onto the rental property YouTube thumbnails. And by the end, one of the answers is going to hit different than you expect. Let's go. Ryan and Jordan are brothers, mid-30s. They grew up in the same house in Columbus, Ohio. Same parents, same work ethic, same conversations around the dinner table about building wealth and not living paycheck to paycheck. Ryan is 34. He works in sales. He's read every real estate book you've heard of. He believes, deeply believes, that real estate is how regular people build real wealth in America. He's watched his parents' house appreciate. He's listened to enough podcasts to think he's an expert. Jordan is 32. He works in IT. He's read a different set of books. He believes that beating the market consistently is nearly impossible, that fees and complexity eat returns, and that the best investing strategy is the one you can stick to without losing sleep. Their company goes through an acquisition. Both of them take buyout packages. After taxes, both walk away with $60,000. Same moment, same money, very different plans. Now let's see how they both decided to use their money differently. Ryan put $60,000 down as a 20% down payment on a $300,000 single-family home in a solid working-class neighborhood 30 minutes outside Columbus. 3 bedrooms, 2 baths, good school district. He takes out a 30-year mortgage at 7.1% interest, the going rate in 2024. His monthly payment is approximately $1,610. He finds a tenant willing to pay $2,100 a month. On paper, that's $490 a month in profit before he spent a single dollar on anything else. He posts about it on Instagram. 300 people like it. His dad calls and says he's proud. Jordan takes the same $60,000 and drops it into a Vanguard Total Stock Market Index Fund, VPI. He sets up an automatic monthly transfer of $400 from his checking account into the fund and turns off the notifications on his brokerage app. He contributes the maximum to his Roth IRA at $7,000 a year on top of that. He tells his brother what he did. Ryan says, "Man, you should have bought property." Jordan shrugs. Nobody posts about this on Instagram. Nobody calls to say they're proud. Year 1. Ryan is living the landlord life. Rent hits his account on the 1st. He drives past his property on the way to the gym and thinks, "I own that." He's writing off mortgage interest and depreciation on his taxes. He's watching Zillow every other week like it's a stock ticker. He's got a story to tell at every backyard cookout from Memorial Day to Labor Day. Jordan opens his Vanguard app in January and sees his $60,000 is now worth $66,400. He closes the app. He opens it in April, $61,800. He closes it again. He opens it in December, $68,200. He tells no one. There is nothing glamorous about what Jordan is doing. There is no key in his pocket, no address he can point to, no Instagram caption. Just a number that mostly drifts upward over time, with absolutely nothing interesting happening along the way. On pure vibes, Ryan is winning by a mile. But vibes and math are two completely different things. Let's run the real numbers for Ryan's first 3 years. This is where most real estate content on YouTube quietly looks away. I'm not going to do that. Gross rent collected over 3 years, $75,600. Mortgage payments over 3 years, $57,960. That's $17,640 left, which looks great until you build the real picture. Minus $3,600 per year, property taxes, average for this bracket in Ohio, minus $1,800 per year, landlord insurance, minus $2,200 water heater replacement year 2, minus $1,900 HVAC service plus partial repair year 3, minus $2,400 6 weeks of vacancy between tenants, lost rent plus cleaning plus relisting, minus $1,100 miscellaneous repairs, leaking gutters, broken disposal, carpet cleaning. After 3 years of actual landlording, Ryan's real net cash flow is somewhere between $1,800 and $4,000, not $17,640. That's before a single hour of his time is accounted for, and Ryan self-manages to save the 8 to 10% property management fee, which means he is also doing a part-time job he is not getting paid for. Let me say that again because it matters. Ryan chose not to hire a property manager. That saved him about $200 a month. It also cost him evenings, weekends, phone calls at 10 p.m., one tenant who broke the lease early, and a dispute over a security deposit that he'll never discuss at the cookout. Jordan, meanwhile, has contributed $60,000 up front plus $14,400 in monthly contributions over 3 years. At roughly 10% average annual return through a full market cycle, his portfolio is sitting at approximately $87,000 to $92,000. He spent 0 hours managing it. He took 0 phone calls about it. He had 0 emergencies involving it. I want to break down the 4 costs that real estate investors consistently underestimate. And I'm not saying this to trash real estate. I'm saying this because these are the numbers that change the calculation completely. Vacancy. The average American rental property sits empty about 1 month per year. That's a full mortgage payment, $1,610 for Ryan, with $0 of income to cover it. When a tenant leaves, you're also paying to clean, repaint, repair minor damages, relist on Zillow and Craigslist, and spend your own time showing the unit and screening applicants. None of that is free. Maintenance and repairs. The standard rule is 1 to 2% of property value annually. On a $300,000 home, that's $3,000 to $6,000 every single year. Some years, it's a $150 faucet fix. Other years, it's a $9,000 roof replacement you didn't see coming because you bought the house in summer and didn't find out the roof was 18 years old until January. Capital expenditures. Roofs last 20 to 25 years. Furnaces 15 to 20 years. Water heaters 10 to 12 years. These are not surprises. They are scheduled future expenses that come in 5-figure chunks. If you are not setting aside a capital expenditure reserve every month, you are not running a real estate investment. You are running on borrowed time. The worst-case scenario. A non-paying tenant in a state with strong tenant protections, like California, New York, or Illinois, can take 6 to 12 months and $5,000 to $10,000 in legal fees to remove. One bad tenant event can erase an entire year's profit. And in the U.S. rental market right now, this is not a hypothetical. It is happening to landlords every day. Now I'm going to stop and be completely fair. Because if I spend this whole video on real estate's downsides, I'm committing the exact same sin as the landlords who only show you the rent check. Ryan used $60,000 to control a $300,000 asset. That's 5-to-1 leverage, and it is the single most powerful wealth-building mechanism available to regular Americans without a finance degree or a hedge fund account. Over 5 years, if that Columbus neighborhood appreciates at a modest 4% annually, well below the national average, Ryan's property is now worth approximately $365,000. His remaining mortgage balance is around $246,000. His equity has grown to roughly $119,000. That equity creation came partly from tenant rent and partly from the bank's money. Ryan turned $60,000 into $119,000 in equity in 5 years, a 98% return on his initial capital, even with all the costs we discussed. Jordan's portfolio does not work this way.
He used $60,000 to control exactly $60,000 in assets. His gains are real. His risk is lower, but he cannot leverage the bank's money to amplify his returns unless he takes on margin debt, which is dangerous in a completely different way. This leverage advantage is the core reason real estate has created more American millionaires than the stock market in multiple surveys, and any honest video about this topic has to say that plainly. By year 7, Ryan is on his third tenant. He raised rent to $2,350, which helps bit, but property taxes and insurance have both gone up too. Welcome to America in 2024. He replaced the roof 2 years ago for $11,200, which he financed over 18 months because the timing was terrible. His cash-on-cash return, the money he actually pockets relative to what he invested, is hovering between 4 and 7% annually after all real costs. That is not a bad return. That is actually a decent return, but it is not the 10 to 15% number that gets quoted at real estate meetups and on YouTube thumbnails. And it required hundreds of hours of active work to achieve it. Jordan, meanwhile, has now contributed $60,000 upfront and $33,600 in monthly contributions over 7 years. His portfolio, at roughly 10% average annual return through a full market cycle, is sitting at approximately $155,000 to $170,000. He did nothing except keep contributing. He did not sell during the 2022 correction when the market dropped 19%. He did not celebrate irrationally in 2023 when it recovered 26%. He just left it alone. Here's what's happening underneath the surface. Ryan's wealth is growing, but linearly, after expenses, with active effort required. Jordan's wealth is starting to curve. In the first 5 years, compounding feels like nothing. In years 6 through 10, it starts to feel like something. In years 11 through 20, it becomes genuinely astonishing. The gains on the gains start generating more new wealth each year than the original contributions.
Let's go to year 10. Full picture. Nothing hidden. $390K to $415K, Ryan's home value, 4% annual appreciation. Minus $225K, Ryan's remaining mortgage balance. $170K to $190K, Ryan's total equity. $185K to $210K, Jordan's portfolio, 10% average return, plus $400 per month contributions. $193,600, Jordan's total invested, initial plus contributions. $90K to $116K, Jordan's pure compound growth. At year 10, they are in the same general ballpark. Ryan might be slightly ahead thanks to leverage and appreciation, but Ryan also spent roughly 400 to 600 hours managing his property, took on $240,000 in debt, concentrated his entire investment in one physical asset in one zip code, and cannot access his equity without a refinance, a home equity loan, or a sale. Jordan can liquidate his entire portfolio in 3 business days. Ryan cannot liquidate his equity in 3 months without a discount. So, who won? Wrong question. The question that actually matters is which path matches your real life, not your ideal version of yourself, your actual life. Real estate wins when the rent-to-price ratio works in your market. You want your monthly rent to be at least 0.8 to 1% of the purchase price. When you have cash reserves for capital expenditures, when you treat it as a business with real systems, not a side hustle you manage from your couch, and especially when you house hack, live in one unit and rent the rest, because then your investment literally eliminates or reduces your own housing costs while building equity. The stock market cannot do that. Index investing wins when you are honest enough with yourself to know you won't sell during a 30% drawdown, when your time is highly valuable,
When you want the ability to access your money without a sales process, a real estate agent, a home inspection, and a buyer who backs out 3 days before closing. And it wins at scale in a way real estate cannot match. Jordan can increase his monthly contribution with a single click. Ryan adding a second property means a second mortgage, a second tenant, a second 10 p.m. phone call. The real trap in American personal finance isn't real estate. It isn't the stock market. The real trap is making a $60,000 decision based on a podcast clip, a YouTube thumbnail, or something your buddy who bought 2 duplexes in 2019 won't stop talking about without ever running the full numbers for your own situation. Before you put a single dollar into either one of these things, ask yourself 3 questions. 1. Have I calculated every cost? Not just the headline number, every cost. 2. Does this path match the amount of time and risk I am actually willing to carry? Not theoretically, honestly. 3. Am I doing this because the math genuinely works for my situation or because it sounds impressive at dinner? Because 10 years from now, nobody is going to ask how your investment sounded when you explained it. They're only going to see the number. In the next video on this channel, I'm going to show you what happens when you do both, own rental property and invest in the market simultaneously with a specific allocation strategy that changes the math in ways most people have never seen modeled out. Subscribe so you catch that one. And if this video answered something you've been thinking about for a while, share it with one person in your life who's trying to figure this out. The math that includes everything is the only math that matters.